Index fund investing has exploded over the past 40 years, starting from around $11 million in 1976 to around $15 trillion today in 2023. But the next 40 years could have some major problems ahead as more and more people pile into this style of investing. You've got famous investors like Michael Burry and Peter Lynch, and they've both spoken out about the pitfalls of passive investing, calling the move to passive a mistake, and then it's destroying the proper function of the stock market. However, with more and more investors choosing this way to invest, are we heading to a situation where it's now time to change, or are there some details that we're all missing? Well, let's take a look. So this is a great topic, and funny enough, I got a comment recently saying, what happens if we all just bought index funds? Wouldn't that mess everything up? Well, the short answer is, of course, yes. It would be like if we all went to the supermarket to do the weekly food shop, but the shelves were bare. We'd have loads of buyers with money ready, but no sellers. Or even worse, we'd have a few items on the shelves that nobody really wants to buy, but the prices would be all messed up. The stock market needs a healthy supply of buyers and sellers, otherwise none of us can do anything, because every time a share is traded or you invest your hard-earned money, someone else has to sell it to you. I think that's something that we often forget about when we're investing, but always a good reminder. Now, in the index fund world, as an investor, you're buying a market-weighted fund, maybe something like the S&P 500. So when you invest your £100 or $100, as an example, the larger the company, the more of that money gets invested into that company's stock. Now, as I'm making this video, your £100 or $100 would look something like this. If it were to be invested in that S&P 500 fund, Apple would be about $7.48, Microsoft would be $6.73, Amazon would be $3.01, and then kind of so on down that list. Now, that's all fine and good, except you might be wondering, well, how do we know if Apple should be right at the top of the list and worth more than $3 trillion? Who decides? Well, the answer is that the market decides. You've got buyers and sellers at any given point have agreed that Apple is worth this amount of money. If you multiply the cost of their shares, which is around $190, by the number of their shares, you get $3 trillion. So this begs the question, what happens if all people buy is index funds and hardly anyone at all buys individual shares or just tries to beat the market? Won't we end up in a really bad situation where some companies end up getting way too overpriced and others then maybe get left behind? Well, that's the argument that some investors make, but what's the truth behind it? So the total value of index fund investing is estimated to be around $15 trillion at the moment, and that's a combination of mutual funds and exchange-traded funds in all shapes and sizes. That's a huge amount of money, but without knowing the value of the whole market, there's no way we can know whether this is big or not. A couple of years ago, there was a point where Bloomberg reported that passive index fund investing had overtaken active management, taking passive investments in the US at least to more than 53% of the total fund market, and this got loads of press attention. The argument against passive investing is saying that if we all just move to passive, then the market won't be getting priced correctly because the price can only be set properly by a healthy amount of buyers and sellers. But remember what I said earlier? How can we know if this is really a problem if we don't know the full size of the market? Well, let me show you. So right now, the total stock market is worth just around $100 trillion. And that's according to this report by SIFMA Research. So that's the number we get if we add up all of the companies on the stock markets around the world. So for some perspective, the US makes up the biggest chunk of that with around $40 trillion alone. Now, what did we say the entire passive market was worth? $15 trillion? So around 15% of the entire stock market is owned by passive index funds. Not quite the scary majority that a lot of people try and make it out to be then, is it? Now, the reason for this is that there are so many more things that make up the stock market. Mutual funds and ETFs on the passive side are just one part of the puzzle. You've got loads of other investors from institutions, pension funds, hedge funds, and then direct ownership of shares from regular people like you and me. Now, for passive investing to ever make up the majority of the market, we'd have to see some really massive changes. But suppose that passive investing does become the biggest way to invest and even more popular over the next few years. Will this change the market completely? Maybe, but there's more that we need to cover. One thing that stands out for me now is that there's so many different kinds of index. It's hard enough as a finance creator to keep up with them at the moment, and we often just say index fund as a way to cover everything. But the reality is there's hundreds out there. The S&P 500, for example, is a popular one and is often a benchmark that lots of people use to compare against. But this is only one slice of the pie. For example, there's indexes for small companies, big companies, UK companies, European companies, dividend-paying companies, really small companies, and even things like growth companies or value companies. You name it, there's an index for it, and it still kind of counts as passive. So you could have a large part of the whole market invested into index funds, but if those funds have so many different companies inside of them, then we're not really going to see the issues which some of the critics of passive investing like to call out. And just on that note, plenty of active fund managers claim that investors into passive funds are somehow doing it wrong. Well, they're obviously going to say that, aren't they? Because turkeys don't exactly vote for Christmas. But let's investigate this a bit further. Why is passive management so popular if these professional money managers are so good with money and just amazing at giving investors great returns? The truth, as always, is buried in the data. So let's have a look and find out really just how passive investing compares to these so-called expert investors. S&P Global, the company that runs many popular indexes, also collects lots of data about how well actively managed funds perform every year against the S&P 500 and other kinds of index funds. Now each year they publish their results and they show what percentage of funds manage to beat their respective indexes. So for some, that might be the S&P 500, and for others that might be a different one, maybe for smaller companies. Now, if we start with the funds looking at big companies, here's the latest results, and we can actually look back in history as well. This shows us what percentage of funds underperform the benchmark. So high numbers in this chart aren't good for the money managers who clearly need to do better. For example, 2022 was a terrible year for pretty much every kind of investment, yet 51% of active managers underperformed. Now, some might argue in those difficult times, the best stock pickers could have showed the world just how good they were and avoided the big drops that the overall market had. And what about the years gone by? 2022 looked easy compared to some of these. In the height of the 2021 bull market, 85% of large cap funds didn't manage to beat the returns of the S&P 500. And you can see if you look back further during many great years, it doesn't get much better. But hang on, you might be saying, well, that's just one part of the stock market. What about the other areas where active managers should be able to use their knowledge to beat the market? What about areas like emerging markets and other sections which don't get so much attention? Okay, well, check this out. Here are all the different indexes that get tracked and how many active funds underperform them each year. As you can see, to be fair, the best section of the market looks to be small cap value funds, where actually they have managed to beat their index pretty well over the last 3 years. So for example, last year in 2022, 41% of funds underperformed, meaning that the majority, 59%, managed to actually win. Nice work. But don't get too excited, ladies and gents, the show isn't over. Unless you only invest for a year or two, this all goes out the window once we look at the long term. Now, taking a wider view, here's where things start to get really interesting. So here's the same chart organised into different categories, but now we're looking at what percentage of funds perform well over the long term, from 1 year all the way to 20 years. There's a very clear trend here, but it's pretty shocking to be honest. The longer you invest with an actively managed fund, the lower the chances of beating the index. For example, the top line looks at all the funds together, and from 3 years to 20 years, you go from just about 12% to under 8% of all funds that manage to beat the index. So, can you see why people are just not bothered with actively managed funds so much and keep choosing the passive route? Let's keep going and say, what if more people invest in passive index funds and that trend continues, which I think probably will. Surely this would make an active fund manager's life even easier. Now, if fund managers want to argue that passive is the wrong way to invest, then surely the more passive money that comes up should show them opportunities in the stock market. For example, maybe a manager might think that a company is wildly overvalued, or even find one that's being left out and selling really cheaply. In this case, passive money would be doing them a favour, as they're able to spot things that passive investors just aren't bothered looking at. If anything, I think passive investment is the kick up the backside that active money managers need, because for far too long in the market, they've taken huge fees and not delivered on their promises, as we've seen. According to the Financial Times, money managers in the US made a profit margin of 26% in 2021, which is more than twice the average profit margin of the S&P 500 itself. Yet, we know that they've delivered poor results. In what industry can you underperform every single year and still have your job? This is where you can insert a very easy political joke. But seriously, it's pretty crazy to think that they're collecting huge fees and not delivering in return back to people who generally don't really know what they're doing and would expect the experts to give them some amazing results because of their years of experience. On that point, it reminds me of an old joke where a tourist is visiting New York and looking at all the fancy yachts in the harbour, and he asks, who owns them? He's told that these are the bankers and then those are the stockbrokers. He then asks the question, where are the customers' yachts? Anyway, putting that to one side, we do need an active market for the stock market to function properly. We need lots of buyers and an equal amount of sellers too, so the real prices of companies can be found. In effect, we need what is referred to as an efficient market. If we only have buyers lined up and nobody to sell to, then this doesn't work for anyone, just like in the first example I used back at the supermarket. Now, there's no doubt in my head that passive investing is going to continue to grow, and personally, I'm a huge fan of this, and the majority of my own investments follow these principles. Passive investing with index funds lets almost anyone get started investing with very low costs and gives you the return of the market, which is actually much better than a lot of retail investors have ever achieved in the past. If active fund managers and stock pickers want to complain about the growth of passive investing, then all they have to do is prove their skills, and then surely the money will just come flowing back. But until they can deliver consistent results, I don't see this trend changing anytime soon. How far will it go and where will it end up? Well, that's anyone's guess, but in my view, new investors should take advantage of them. And then if you want to get involved maybe a bit more actively, then maybe take a small amount of your cash and play around with individual stocks yourself, or buy some funds from the active people. Now, when it comes to choosing the right index fund for you, here's a video I did where I compared the S&P 500 to the world, and I think you might be interested in what I had to say on this one. Anyway, thanks so much for watching. I'll see you in the next video, and as always, happy investing.